Good afternoon and welcome to the Coinbase Institutional Markets Call. It is Tuesday, the 20th of August. We are midsummer here in New York. It is stifling hot outside, but we are still at it and the space continues to grind on. In fact, we've kind of recovered a good amount from the volatility over the last couple of weeks. Greg, I'm curious, obviously you keep a super close eye on basis. And we have a guest today that's going to run through that in detail as well. Like, how are you looking at the market now? And have we fully recovered, or are there still concerns, or are still kind of remnants of some of that market volatility in the system?
Yeah, it's a good question. No, we haven't fully recovered if you look at just broadly price levels. And I think there's some disappointment among crypto traders, at least the ones that I speak to. We're looking at other markets, U.S. equities, gold. They're up almost every day. Our market has been a little choppier. But one positive sign, I think, is if you look at funding rates, for a lot of tokens, especially the more liquid ones, Bitcoin, ETH, Solana, they're at near zero or even negative in some cases. And that's usually indicative of markets that have had a lot of length essentially cleaned out. So positioning looks pretty good here. Basis isn't negative. We're still seeing positive rates there, kind of in the mid to high single digits. So overall, things look healthy. I think now we're just hoping for some upward price movement.
I think one thing is always a constant in crypto, or two things maybe. One is we're never quite happy with our performance of our asset versus every other. So you mentioned gold, you mentioned equities, and we always want to be on the right tail of that. And then the other one is perhaps I think we can find a positive angle on most news, but we are optimists, and that's why we're all doing what we're doing. So moving to the show, we have got a fantastic guest, Jim Hiltner, co-founder, head of BD at Superstate, one of the most exciting tokenization projects out there. So we'll be running through some of the products they've launched now, what they're looking forwards to in the future, thoughts around regulation, who their clients are, a ton of interesting content there. We're also going to have a macro update from David, Jackson Hole this week. Obviously, we're still very much looking at the first rate cut. A general market update, what's going on with the ETFs. We had 13 F filings this week, and other things to be keeping an eye on. And then last week, we'll finish with an Onchain section covering makers' vote around WBTC, their RFP for their treasury, or $1 billion of their treasury, and a few other things around EigenLayer as well. But before we get into it, please don't forget to subscribe. If you're on podcast, hit that subscribe button. If you are watching on YouTube, you can do the same. And you can also scan the QR code on your screen now to access all the team's fantastic research. If you're listening on podcast, we'll add that info to the show notes. And we are super excited to welcome Jim Hiltner, co-founder and head of BD at Superstate, to the show. Jim, welcome to the show.
Thanks for having me, Ben.
Great to have you here. Superstate is a super exciting company in the space, no pun intended there. And would love to kick off just with a bit of background on yourself and how you got into the space, and also why you founded Superstate.
I also find myself using super way too much these days, so no problem there. Yeah, I mean, my background is very traditional finance. Started at Citibank, was doing all the boring stuff there, and decided to move into trading, and got the bug for tech. Was at a company where, we were in the equity research space, helping, big institutions kind of figure out, where estimates were from the sell side. And so that was a great run, built that company up for about 6 or 7 years. And then, all the time I was, looking at crypto and playing in the space, and decided to make a full plunge into Compound. So I joined about a week before Terra Luna blew up in May of 2022. So it was good timing to go full right into crypto. And, I think it was the best opportunity to see exactly how this market operates. It was, very, very chaotic and volatile from like a CeFi perspective, as you are well aware. But, we had a really good first person perspective as we were watching, all the DeFi protocols continue to operate exactly the way that they were designed. So, through that experience, we're kind of sitting around and thinking through, how do we grow more assets in these markets? And instead of just focusing on one particular protocol, decided, go back to the drawing board and launch a business that can touch a ton of different chains, a ton of different protocols. And so that was what led us to launching Superstate. And so, very plainly, we're an asset manager. We run a couple of funds, but the funds that we operate don't just have a traditional, backing, but they also have the ability to tokenize those shares, which open up a surface area of a ton of different use cases and integrations. That's really cool that, excited to dive more into, but that's kind of our origin story.
Very cool. So that makes a ton of sense, and it's great to see people kind of bridging DeFi and TradFi. Can you elaborate a little bit on, I guess, the company's vision and mission and how you see that evolving over the next few years?
Yeah, I mean, when you look at traditional financial services, historically and even today, a lot of the asset classes don't interact very well together. And so you have all these different siloed systems, across various counterparties and entry points and different settlement networks and whatnot. And so, by bringing things on a blockchain, you just bring superpowers to those traditional assets that, allow for much more efficient collateral mobility, much more real-time insight into where positions are and risks. You have 24/7 access to capital markets. So there's a lot that needs to be done to realize the full vision. But, kind of what we see is that, instead of everything living on spreadsheets and being done on a, T+X basis, that by wrapping assets in a token, you open up a surface area of a ton of different opportunities that, really just upgrade the financial system. And I know that, Coinbase has a ton of interest in this space and has been very active. And so I think we align very much to do things the right way as well. We're not looking to launch a protocol or projects that, are a quick go to market. And we're really focused on the regulatory compliance and institutional infrastructure behind all this. So if you peel back a lot of the products that we run, they look very traditional underneath the hood in terms of the infrastructure and the operations and the compliance. But what's interesting is that you can then go into a token, which gives you a lot more that you can do with something that otherwise would have been less interesting. So that's our goal and our mission is to take advantage of all the great technology that's built and bring capital markets on chain.
Yeah, I totally hear you there. And I feel like some of the things you said there, so it's about transparency, it's 24/7, it's accessibility, opening up the TAM, which all makes a ton of sense. Can you talk through some of the key products and how they differentiate from existing solutions in the market specifically, and maybe names from the ones that you're working on right now?
Yeah, so we've got two products. Our first flagship product is called USTB. It's a ultra short duration government bond fund, which basically means that it's got T-bills, 15-day, 20-day weighted average maturity T-bills in the fund that offer, a yield right around Fed funds rate. So 5.35%, call it. That product gives investors access to yield when otherwise they'd be sitting in stablecoins or cash and, not earning what is obviously a very healthy return. But not only is it a balance sheet tool, it's also, the ability to operate more capitally efficient in secondary markets. So, clients are using it as collateral. They're using it to be able to settle trades. So having a token allows investors in the fund to interact bilaterally, peer-to-peer, and do it in a KYC compliant way, but ultimately, much more efficient than going on-chain and off-chain, touching T-bills in a brokerage account and coming back into, minting USDC to go do on-chain transactions. You can do that, kind of with a click of a button directly on-chain and still get the exposure you're looking for under the hood. So that fund's about $100 million in AUM right now, a pretty diverse client base. But we just launched our second fund, which is, really interesting. It's USCC. It's our crypto carry fund. So, in conversations with clients over the last, number of months, a lot of the feedback has been, we're looking for something with, similar counterparty structure as I was talking about in terms of, really institutional, but they wanted higher yield. And they wanted higher yield in a method that they weren't going to have to lock up capital for 6 months, a year or more. So, the strategy that we built with this fund is very, very simple underneath the hood, and it checks a lot of those boxes. So USCC is a crypto carry fund. Basically what that means is we're doing the basis trade inside of a portfolio where we are long spot Bitcoin or ETH, short Bitcoin forwards, whether that's August, September, December, different calendars, depending on where the yield is, makes sense. And we're actively managing that portfolio to do a few things. One is, to take advantage of yield when it's there. And the second thing is to stake assets when they're not, being deployed in other ways. And so what that means is that we have set up the strategy so we would only put basis trades on when the yield is a couple hundred basis points above T-bills. So if the yield is not sufficient, there's no reason to take risk. We're just going to go back to treasury bills and hold, a highly liquid, high yield product like that, like USTB in the fund, so that you're earning, Fed funds rate. As spreads widen and the opportunity in basis is there, we will allocate the portfolio towards basis and again, market neutral, high yield type of strategy. The other piece that I was mentioning is that, we are able to stake ETH underneath the hood, for example. So for any of the ETH that is on the long side, we're able to then go and put that into, and to stake that directly to earn a couple of extra 100 basis points for the yield for the fund. And gives a really nice rounded exposure for clients. All of this is set up so that investors see the positions every single day, and they're able to get liquidity every single day as well. So not only does it give you high yield, but it has that liquidity element as well that is very complementary to what we've done on the treasury bill side.
Yeah, thanks, Jim. We were looking at this earlier, and one of the things that caught my eye is the trailing 30-day yield. I think it was at around 13%. It's actually higher than where basis has been. Can you talk a little bit about how you achieve that? I mean, how do you get a higher yield than where I see basis?
Yeah, it's a really good question. And it's because we're actively managing the fund. So if you kind of rewind a few weeks ago, before the big unwind of the yen carry trade, when markets really, came in early August, we were putting on trades in the fund at 11, 12% in basis, with a varying degree of maturities, whether that's August, September, December. As you sit in those positions, you're going to be earning the market yield. But with the sell-off that occurred pretty shortly after we put our positions on, basis actually came in a ton. So that spread narrowed quite a bit, and we were able to react and reallocate the portfolio back to treasury bills and take them off of those positions. And because of that, quick unwind and activity in the fund, we're able to, increase returns on the portfolio and capitalize on those opportunities as, things, were pretty volatile over that weekend and spreads came in, which was a big boon to the overall return for the fund. In addition, if you're looking at just funding rates, or you're looking at just yield, that's only one part of the picture. As I was mentioning, in the fund, we can also stake ETH that's on the long spot leg of these positions. So that also adds additional return to the fund that helps increase the overall 30-day yield that you're just referring to there.
Yeah, that makes a lot of sense. How do you guys think about kind of the opportunity set in basis? We talk about it a lot on this podcast, and one of the things we're sort of struggling with is, in the past we've seen very high returns to this trade, but now with the advent of we have the ETF, there's large multi-strat funds that have sort of come to play in this sandbox as well. Do you expect basis to continue to be, 10, 12, 15%? Or do you think, those returns will decay a bit?
I think certainly this arbitrage will be taken away at a certain point. It has been, historically extremely juicy, as you point out, in the low double-digit returns. And part of that is just because of market structure. You've got a lot of interest and leverage on the future side. So there's a just inherent bid in the market, and especially a lot of that's expressed in unregulated exchanges like the Deribits and the Binances of the world. As you can see, a lot of activity on those, but a large spread between spot. And so there's a similar setup in CME and some of the other regulated exchanges like Coinbase as well. that has a an inherent bid in it as well, and there's still some challenges with cross-margining the spot leg into the futures leg to make this a really capital efficient exposure. Especially when you look at some of the margin requirements for regulated exchanges, that if you're a large multi-strat, it's tough economically to really put this trade on. But I think as you see more size come into this market, as you see options on ETFs, as you see the ability to cross collateralize ETFs, this opportunity might go away. The interesting thing about our strategy, though, is we're very focused on BTC and ETH right now, but we have the mandate to be able to trade any CFTC commodities, crypto commodities, in the fund. So that means that in the future, if the spread gets tight in BTC and ETH, but there's volume and opportunity in Solana or AVAX or other tokens, then we'll be able to diversify the portfolio into those as well. So flexible mandate will give us more opportunity in the future, but certainly as more TradFi comes in and some of these market structure things get solved, it's going to compress some of the opportunities that are there right now.
Jim, I'm curious, how do you differentiate versus some of the other kind of similar products out there? We had a guy from Athena on the podcast recently, which feels like a kind of a very, very DeFi native way of doing it, whereas yours kind of fits in between. I'm curious kind of some of the pros and the cons versus other solutions out there.
Yeah, I mean, fantastic product, by the way, what they built over at Athena. And so I think it differentiates in a few ways. One is we take a very institutional approach where, our clients are looking for, investing in a fund with, Ernst & Young as the auditor, and it's in a bankruptcy remote Delaware trust. It's not a protocol. It's a fund product. So much more natural for, an institutional TradFi type of audience that want to have those types of protections. The second thing is from an investment strategy standpoint, we are not touching perps. We're trading term products in this fund. So, given the market structure where it is right now, you see perps have just come in like crazy over the last 2 weeks. And you have, a ton of open interest that has just declined over that period. So you get negative funding rates or really low funding rates in perps. And, that's not true when you look at the term futures, which still have a bid of, a nice spread of 9, 10, 11%. So, that's why our 30-day yield is, low double digits and not sitting, below 5% right now. The other part of the portfolio is that, we can go back to cash and we can go back to T-bills. So, because I think the way that they structured their product, which is really interesting, from a synthetic dollar and yield perspective, it has a different mandate than what ours is doing. And ours is trying to really, protect investor capital when the yields are just not that sufficient above Fed funds. So, you'll see the holdings on our page, like we hold USTB, our treasury bill product, when the yield and basis is like 6 or 7%. Our philosophy is don't take that market risk, put it in treasury bills and wait till the opportunity opens up again. So, an actively managed mandate, to be able to trade in and out of basis and cash or cash equivalents like T-bills makes it a different strategy than what Athena is looking to do.
Jim, it's interesting. You mentioned the difference in yield between term futures and perps. We were talking about this last week, actually, when we used to see like a huge dislocation. I'm curious, from your perspective, why is that the case where you could see term futures positive, but then perps heavily negative?
I mean, I would say that it would be, largely due to leverage. There was a lot of unwinds of positions that happened over the last few weeks, just given, the massive moves on that Sunday night, the 4th of August or whatever the date was. So you have, a natural unwind of positions that, take people away from the markets. And a lot of that leverage is kind of built up into perps versus, on the futures or on the term side. You don't have as much leverage and unwind in those positions. And, there's a dramatic difference in open interest on the perp side versus the term future side. So that also kind of plays into some of the dynamics there. But it is an interesting, activity. You would think that there'd be a lot more correlation between the two. But at the same time, yesterday, for example, ETH August futures went negative on Deribit. So, there is a high correlation. It's just, by locking in these positions before these market moves happen, is what benefits a strategy like ours. And then, waiting in cash when things aren't juicy and going back into it is what allows us to take advantage of things when they do widen again. And instead of earning negative rates, you're earning 5%. So, that's from our perspective and from our client's perspective, a much better value prop.
Interesting. And who, you mentioned clients, like who are your kind of key clients? How does this split down across the various different people that invest in digital assets?
Yeah, it's a good question. So it really spans the gamut. I'd say, on one end, it's your whales, that are looking to put this trade on, but don't have the time or the, counterparty setups or relationships to be able to execute this themselves. The second thing is, going to, protocol treasuries, that have a, decent amount of their assets that are maybe sitting in treasury bills, but they want to earn higher yield. They're like looking out, a year, 2, 3, 5 years. And they're saying, hey, if I just keep everything in T-bills, I'm not going to be able to, satisfy the working capital and kind of like balance sheet requirements I have to like continue to grow the business. And, I think the third piece is like venture and hedge funds that also, have a cash allocation in their portfolio, whether they're a VC fund that's already drawn capital and they haven't deployed it yet, or maybe they've just exited a position and they're waiting for distributions. They're like, hey, why put that in cash and drag on my portfolio? I can put it into, a product like this and earn higher yield. Or they're a hedge fund and they, might be risk off in the book and they're going back to a position like this instead of managing it themselves. They can focus on, their liquid strategy of like picking the right tokens to long or short or whatever, other strategy that they're running, and just outsource this part of the mandate to Superstate to be able to, take their cash and deploy it in something that's going to earn, the 10 or 11% that it's doing. So it spans the gamut. I'd say that's a very crypto native view. We're getting towards the TradFi, adoption as you guys talk about on this podcast all the time, starting with, a lot of the products that you guys are very heavily involved in. I think, for the nascency of a strategy like Superstate's USCC fund, that's going to take some time for like, traditional LPs and allocators to really take seriously, as, they're going to need track record and more history behind some of the strategies. We only launched 3 weeks ago, so premature to be there. But there are a lot of family offices, as you know, that are super crypto native or excited about this space. And, this gives them a nice product to invest in with, daily liquidity, visibility into the portfolio, plus a, infrastructure behind it that they can go tell their CIO or the family, like, this isn't scary to put money into.
So it sounds like the way the strategy works, you integrate pretty seamlessly within traditional financial systems and somewhat in the DeFi space as well. But how does Superstate kind of navigate the regulatory and market challenges that you typically have in the space?
Yeah, it's a great question. When we first launched the business, we actually put a prospectus out to the SEC for our treasury bill product to launch it as a registered investment company. So basically make it a security. I think things are working in a positive direction. I give Franklin Templeton a ton of credit, who've been spending a lot of time with the regulators demonstrating the efficacy of a on-chain register versus an off-chain register. And so those are the types of, progress that's the type of progress that we like to see with the regulators. And that's things that we're engaging with them directly on to prove that what we're trying to do is not scary. It is very traditional in terms of what the fund is doing and how it's structured. It's, from our perspective, set up just like a security should be. And the only thing that we're doing in terms of navigating now is that we've made these private funds. It's unfortunate, we don't allow retail or smaller investors into our fund, and we can only take investors from certain jurisdictions so that we maintain compliance with the regulatory apparatus as it stands today. But I think what we're seeing is a progression in conversations with the SEC in particular, in order to allow these types of products to be more accessible. And what's going to be required there is to acknowledge that a blockchain-based record of ownership is not necessarily a crypto token. There's a big difference between the two when you have like a fund backing a token versus a protocol backing a token. Those two have two different conversations to be held with the SEC. So the way we navigate it right now is to ring fence it to just qualified purchasers in our funds and certain jurisdictions we allow. But the goal eventually is to, open it up so mom and pop can invest in these types of strategies. We think that they would benefit greatly from not just the allocation or the exposure that's in them, but also, the utility that a tokenized version represents.
So outside of the US, you have a lot of countries right now, a lot of different regions introducing new regulations for digital assets and DeFi more broadly. How do you see these developments impacting Superstate's operations and the broader financial ecosystem?
Yeah, I think it's all tailwinds towards future integration between these two markets. You have a lot of activity. I'll take Project Guardian in Singapore as an example, where you have the regulators, the Central Bank of Singapore, integrating or, working on a sandbox with a bunch of large asset managers and large banks and to create a collaborative space for these types of innovations to thrive. Same thing's happening in the UK. I think the US is behind all that. People don't need to hear me go on my soapbox and talk about the same thing everybody talks about. But, I think what's going to happen is you'll see as more banks can custody assets, as more asset managers can issue products, as more broker dealers can interact with these products, and as more exchanges can do the same, then what happens is a convergence between traditional capital markets and crypto capital markets. And this is a total benefit to the entire financial services ecosystem because, of all the characteristics that we love about tokens in terms of transparency, settlement, and distribution, and all the things that don't exist in the world today. That's very siloed and inefficient. But it's going to take regulatory engagement and real changes in order for this to materialize.
Yeah, thanks, Jim. That's really interesting how you guys are trying to bring over a lot of the Web3 kind of transparency, scalability things into the Web2 TradFi world. I know in Web3, one of the big things that a lot of people just care about is the technology, like code auditability, et cetera. And obviously, you guys aren't necessarily Web3 native, but I'm kind of curious, can you guys provide any insights onto kind of the technology stack behind there? How do you guys ensure security? How do you guys manage the technological risks? And is that different? And how's that different from your experiences at Compound and the Web3 world?
Yeah, it's a great question. Our engineers, by the way, and all of our team come from this space. A number of our engineers are ex-Uniswap and Frax and Compound and Scroll and you name it. And obviously you got Robert Leshner at the helm, who is the OG king of DeFi. And so, we bring a lot of that innovative side to the business, but also, from, I've got a caller on today. We do have a very TradFi side of our business, which, the merger between the two of those is exactly what we're trying to produce. So from a technology stack perspective, it's actually pretty simple. Like, a traditional fund exists behind the scenes. Assets under bankruptcy remote trust. It's a Delaware statutory trust. Everything is either held, T-bills are held in a custodian at a bank, or crypto is held at a custodian like Anchorage. The valuation is done every day by a third-party fund admin who calculates and does accounting for similar type of funds and traditional funds for the hundreds of billions of dollars. And then you have the asset manager ourselves who are deploying the capital per the mandate. When you go through the onboard with Superstate, we built a proprietary onboarding tool. One of the things that I hear all the time is onboarding sucks, and that is really a shame, because it really shouldn't be that difficult for people to get set up and open different accounts at various counterparties, whether that's for trading or for investing or for any other thing. So we spent some time to actually build our own in-house onboarding tool, which clients can fill out. Literally, I've seen people do it in 30 minutes. And it's not this like protracted going back and forth negotiation. It's a very simple SaaS tool that people can upload documents and be done with it. And that's the kind of reduction of friction that this space needs in order to bring people on board and have them get access to products that they want really quickly and easily. Then when it comes to the token side, as investors on board, they tell us an address or multiple addresses that they'd like to hold the token in if they choose to, tokenize their shares. We do offer an option, we call it book entry, that folks don't have to take a token, but they can. That token is an ERC20 token. It's built proprietary, bunch of audits on it. That token refers to an allow list of addresses that are client-specific addresses on Ethereum right now, where they maybe hold them at Coinbase or Anchorage or Fireblocks or BitGo or you name your custodian. So every token that's minted or transferred needs to be done with an address that's in that allow list. That allow list is basically, a roster of addresses that all of our clients have that enable the token to transfer and be minted and be held by those, so that we maintain compliance per the conversation earlier. That is a big component of our business. So that's basically the infrastructure. We're not custodying the assets, we're not custodying the tokens for clients. It's all self-custody. Clients come in and out of the fund, USDC or dollars. So they either send USDC to a deposit address, which, we've got a partnership with Circle, or they send wire cash into the fund directly. And then on the way out, it's the same thing. They can get cash out or they can get stables back to their custodian. So it's a really crypto native experience, kind of like weaving in all these different like legal and infrastructure players. But at the end of the day, it's an ERC20 token. And we built it that way so that other protocols can continue to, build integrations, whether it's on the DEX side or the lending borrow side or whatnot, so that these tokens can be used in much more interesting ways than just being held in an account.
And how about future opportunities? Where do you see the interesting new products that you guys can create? Obviously, you started with treasuries, made a ton of sense where we were from a rate perspective. Carry trade, again, one of the most attractive trades within crypto. I think a very smart one for you guys to pursue. Second, like what is next and what are you excited about?
It's a really good question. I mean, I get this all the time, and folks are chomping at the bit to figure out what's third fund, fourth fund, 10th fund out of Superstate. We're 3 weeks out since launching the carry fund, so a little bit premature to like put our flag in the sand and say, hey, this is the next strategy we're going to launch. But I see opportunities on total return products that don't exist right now in the TradFi space. I see opportunities in even just bringing more equities and traditional asset classes on chain. So it can really span the gamut. I mean, we actually are having conversations with, folks that want to put real estate on chain and do that in an interesting way. So, we've set ourselves up to be largely asset class agnostic. But rather than just putting stuff on chain, we're taking a very pragmatic approach to making sure that there's demand behind these products. And so very clear, like you said, treasury bills in this carry fund, like we saw a ton of demand for that. So that's why we built it. As we continue to navigate conversations, we'll figure out what the next strategy is. And one of the driving forces behind that is what we call the Superstate Industry Council. Today, we announced actually 15 new members, including the Hidden Roads, the Coppers, the Zappos, the Republics of the world that are part of this cohort of members that are 35 of the top funds, custodians, prime brokers, you name it, institutional players in crypto that we work very closely with to define roadmap for new products, new integrations, different ideas, and making sure that we're very demand driven in everything that we do. So something that we're really proud to have brought together and continues to flourish and grow. And today we announced another 15 members. So that'll be a large part of the driving force behind future products that we launch.
Yeah, I think this is so great hearing this, because we all have conversations when we talk about how we need to get people involved in the ecosystem with products that make a ton of sense to them, but also benefit from the new tech stack that you can get within digital assets, and whether it's this or whether it's gaming or other sectors that kind of allow you to experience Web3 without going through complex onboarding, I think is super, super key. Jim, thank you so much for joining us. We'd love you to stay on for as long as you're available, but how can people find out more?
Yeah, it's really appreciate the opportunity, Ben, by the way, and the team has some great questions. We are at superstate.co. Easy to find us. All of our fund information's there. You could reach out to me. I'm Jim at superstate.co. So don't hesitate. And then, find us on Twitter. At Leshner is a pretty big guy in the space. So I'm sure you'll find him pretty easily. But we'd love to chat with anybody that's interested in learning more about what we're doing.
Fantastic. Jim, thank you so much. So switching gears now, we had 13F filings this week. So quarterly filings for firms with over $100 million of AUM and what they're holding. Dehan, over to you, sir. What were some of the highlights from those filings?
Yeah, definitely some interesting names that popped up there. Just as a quick recap, these filings were a snapshot of what happened on the end of June, so June 30th, even though they came out on August 15th. So these firms have 45 days after the end of the quarter to file. Overall, in these ETFs, also just another quick recap, we saw around $2.4 billion of inflows in second quarter, even though the total AUM dropped from 59 billion down to 52 billion because the price of Bitcoin depreciated. But we have net inflows. So I think that's one thing that's kind of worthwhile to note, which is that we just have net inflows into the ETFs throughout the second quarter. I think the first highlight I would say is that the institutional share of ownerships has gone up from 21% to around 24%. So it's gone up a little bit, even though Bitcoin's dropped. So I would say that suggests that there's some more institutional interests. And the second thing is within these institutional owners, the percentage of reported owners that are investment advisors has gone up from 30% up to 37%, which is a pretty significant share. At the same time, the hedge fund tagged holdings are down from 38% to 31%. So that's been kind of displaced. So more investment advisors, less hedge funds. And I think a few major investment advisors that we want to that are kind of worth highlighting. One is Goldman holding 412 million. Morgan Stanley now holds 188 million. So Morgan Stanley used to hold GBTC, but then in the 13F filings from March 30th, they had closed their position, but now they own ETH or Bitcoin ETFs again. And recently, we also saw Capula Management, Europe's fourth largest investment manager, disclose holdings of nearly $500 million in spot Bitcoin ETFs as well. So a lot of new names that are coming into that. Overall, we saw more holders that are filing, 951 up to 1,266 unique holders across the space, which is incredible. Some of these other ETFs only have, a few dozen, if maybe on the low hundreds. But within 6 months of launch, we've had more than 1,000, large funds who are holding these ETFs. So a lot of excitement, not too much of a drastic shift, but I think this kind of shows the trends where we're going to have more and more investment advisors as more wirehouses and essentially give clearance for their advisors to solicit clients to hold Bitcoin ETFs.
And the Morgan Stanley and Goldman specific holdings, like what do we think those are? Is that they're part of their investment advisory businesses? Is that their trading desks to facilitate flow? Like where do we think that kind of fits within their larger businesses?
Yeah. On the Morgan Stanley side, that one's pretty clear, at least tagged within the Bloomberg data. That's definitely for their private wealth management, private banking businesses. The brokerage, listed as like holding very, very little. Most of it is on their investment advisory services. My guess is probably similar for Goldman as well at this point. They have a very large private wealth management business. And it seems like a lot of their holdings are also labeled under the investment advisory services.
It's great. It's a great direction of travel. Momentum has obviously slowed down a little bit from the kind of launch of these, which one would expect, but the momentum continues to be positive. And let's go to Greg here, who's going to run us through some of those ETF flows and touch on the fact that we haven't seen huge outflows, even in some of the market weakness.
Yeah, that's right, Ben. The momentum certainly has slowed. Last few days we've seen single-digit $1 million flowing in and out of these products. The Bitcoin products are, for the most part, still seeing inflows. Again, just a few $1 million a day. And the ETH products are seeing outflows, but very low, just a few $1 million a day. So you can kind of call this net zero at this point, especially when compared to the 10 and $100 million days we were seeing not long ago. But you do bring up a great point. We had this big drawdown in prices, and we really didn't see massive outflows out of these products, which again just speaks to the stickiness of the capital here.
Very good. Well, hopefully that continues in that direction. Now moving on to miners, DD, would love to bring you in here. There's been a couple of bits of news here that I just want to kind of run through very quickly.
Yeah, I mean, I would say that overall, the miners have been doing fairly well. I'm talking about the Bitcoin miners in the post-halving period. A lot of things have settled for them. So I think that it's been positive. A lot of that has to do with the fact that they can kind of leverage off of not just what they're doing with Bitcoin mining itself, but also what they can do with AI data centers, for example. But we did, however, see a regulation proposed by the IMF, which would implement energy taxes on these miners, and that would be intended to curb carbon emissions, for example. But the concern there would be, of course, that if you apply such taxes, yes, you may help reduce some of these global emissions, but we're not sure about the economic ramifications of them.
And we've also heard a lot about Bitcoin miners moving into AI compute and using some of the data centers. Dehan, I know you've been looking at that a little bit. How much of that is real? How much of that is narrative? Obviously, we all love a narrative. So what's really happening?
Yeah, I think there's definitely some realness to it. I would say that energy is one of the big bottlenecks of AI. I know the run up in Nvidia has put a lot of market attention on chips, but you have a lot of big firms like Microsoft or Google who are actually investigating building out their own power plants so they can power all these chips, which is kind of incredible when you think about it, that a tech company is investigating building out a power plant that could power a small city just to build out these AI chips. And Bitcoin miners are really perfectly situated as on the power grid to make use of excess energy and to be able to kind of do these power sharing agreements. So we have a few names, CoreWeave, Iris Energy, they've entered AI deals. That said, from some talks I've had with various people, it's not super easy for all miners to diversify into this. There are some technological skill sets that are required because running AI chips and Bitcoin miners is not a 1-to-1 ratio. There's a big step up in terms of the software that's kind of required. But overall, I think that Bitcoin miners are pretty well situated to capitalize on the energy intense nature of AI mining chips, and we've started to see that shift a little bit.
Very cool. Now to politics. It's been a little quieter from a crypto specific side of things on the political front. But we did have the DNC last night. I'm not sure if that's a couple of days. It may still be ongoing today. And we have heard news from that camp. David, what are the things that we need to know there?
Yeah, I think it was the Trump campaign that really kind of made crypto a focal point for their potential administration. And now that, we've seen a switch in candidates, I think that Kamala Harris is now driving the issues that they're going to be debating. And so I think that this is also kind of deprioritized crypto somewhat towards other things that I think now the Trump administration the Trump campaign itself is going to find that they need to defend against.
Perfect. And David, what we've got you here, macro side of things, obviously Jackson Hole this week, so looking out for that on Friday. But what else should we be keeping an eye on? How are you thinking about the macro space vis-a-vis crypto in general?
Yeah, we're 2 weeks out now from, I think, the volatility that started the month. So, we don't have to worry quite as much about the over leverage that we've seen in the system because the short yen, the carry trade has kind of been unwound. And even inside the crypto space, if you're looking at individual protocols like Aave and other things like that, certainly the leverage in DeFi has also kind of been taken off. Jackson Hole is still going to be probably the most important thing to watch out for on the macro side. We do have the Fed minutes that are also coming out this week. I personally think that the U.S. economy has been fairly resilient, though, and the disinflationary trend hasn't really been interrupted. So that's been as close to a soft landing as you can get. So I don't expect to see a hawkish surprise in the minutes, for example. But we did see that 2-year rates have fallen from 5% in May to below 4% to start this month. We have seen some retracement of that, but it's kind of interesting to see the 2-year, 10-year spread close the distance over the last 2 months, only just flatten again, and now it's parked at around 18 bips inverted. You're all seeing that CFTC data itself is showing that the shorts in 10-year U.S. Treasury futures are now at the largest since January. So we have all of this going into Jackson Hole, which is coming up on August 22nd and 24th at the end of this week. We also finally have a title for this year's Jackson Hole theme, which is reassessing the effectiveness and transmission of monetary policy. So a big lofty title, as per a lot of these kind of conferences. But, the big question in the cycle has been, have higher rates cooled the economy more than expected? And if so, does this mean the Fed will also need to deliver more rate cuts than expected? Or will they just, have to keep rates low for longer when they do start cutting? So I think this is what people are going to be watching for as we get closer to the event.
Thanks, David. As always, a lot for us to keep an eye on there, and macro at the moment is playing a big part for our direction of travel. Now, moving on to on-chain things. Dehan, we were talking over the week about the WBTC update and Maker. Can you run us through how that vote went and what happens next?
Sure. Just a quick refresher. Bitcoin was transferring the Wrap Bitcoin custodianship to a joint venture with BitTorrent and moving it outside of U.S. regulatory, the U.S. regulatory jurisdiction. And so there's been a vote on Maker essentially to delist Wrap Bitcoin as a collateral asset for DAI. That proposal passed. What does this mean? It doesn't mean that all their positions can be liquidated directly. It just means no new positions can be added, but people can withdraw. So that said, we actually haven't seen any mass withdrawals at this point. The total Wrap Bitcoin market cap has remained roughly flat. There's been some decline since the news, but by only about 0.5%. So it remains roughly flat at around 154,000 Bitcoin. So I think that's still generally stable, nothing to kind of worry about or panic about, and everything still seems to be reasonably orderly at this time.
Yeah, it's interesting to see that vote happen in the public and for them to move in that direction. I guess what's also interesting is thinking through some of the RFPs that Arbitrage put out with regards to their treasury and the one upcoming one that Maker have as well, and seeing this on-chain governance happen in real time. Obviously, as we get more of these, I'm sure it's going to get smoother, but there are some pretty big treasuries at stake here in terms of kind of where they get invested, and it means a lot to the people obviously investing in the underlying as to where these assets are held. Now, staying on chain, there was also some news around Eigenlayer. David, do you mind just running us through that, Dehan?
Yeah, sure. I think there were two big announcements on Eigenlayer. The first one is a long anticipated release of rewards going live on Eigenlayer. So for the longest time, you're actually not receiving any restaking earnings. It's been mostly the airdrop that people have been kind of farming for, waiting around for, and now the earnings are starting to trickle in. And when I say trickle, I mean it's starting to trickle in at a very small pace. So the very first AVS to begin rewarding stakers is EigenDA, but it's a very small kind of nominal amount of 10 ETH per month to the entire asset base, which is kind of a rounding error. But the main rationale behind this is that Eigenlayer has a programmatic incentives program, which will distribute a certain amount of the Eigen token to each AVS staker. So it's you're not only getting ETH, but you're also going to be getting some of the Eigen token as well. The exact proportion or the exact number of that isn't clear yet. But I think it's good to see that some rewards are coming in, although there is some concern around the total number of rewards relative to the amount staked. There's $12 billion locked in Eigenlayer, and the rewards right now seem to be a very small fraction of that. So that's the first big announcement. The second big announcement is that Eigenlayer is actually looking to make any ERC20 token usable or restakeable for shared security. And it seems pretty interesting to look how the restaking narrative has gone from, ETH has excess security, so it can be used for this restaking purpose, into, Eigen as the intersubjective work token, to now any ERC20 token. And I think part of this is also because of competition. So we have, it's not just Eigenlayer that's dominating the restaking scene. There's Karak, there's Symbiotic on Ethereum. Jito's exploring this on Solana. And some of these competitors are actually looking to launch any restaking with any token. So it seems almost like a forced move for Eigenlayer to kind of follow suit. So I think that's interesting. I think that might have some implications on, which assets are restaked. I still think ETH is probably the most pristine collateral asset, but you might have more and more competition for other protocols that want to use specific ERC20s for this restaking security.
And what do you think that does, allowing more assets to be restaked? Does that affect the security at all? Does that make it? How do you think that? How should we think about that?
I think it would affect security for AVSs that actually use the ERC20s to restake, and I think this is kind of where I would start to say you need to actually look more deeply into the security. Because if you're using ETH, for example, just as a restaking collateral, ETH is a great asset. But then for now that it's kind of opened up into this full universe of ERC20s, I think that it requires a little bit more due diligence on the behalf of users and investors to actually look into, what's securing the different AVSs as there starts to be more differentiation. I think that's on the security side, that's a big one. On the second one, I think there's also the unspoken impact of liquid restaking tokens. My hunch is that a lot of these LRTs are going to be selling most of the AVS rewards or whatever for ETH if the LRTs are denominated in ETH. So I think that might provide some kind of consistent sell pressure on some of these alternative ERC restaking / reward tokens. So I think that's also another dynamic that should be just kind of monitored, especially given that a large fraction of all eigenlayer deposits are now wrapped in LRTs.
I guess what was encouraging, we did have, albeit a very short-term, extreme market decline a couple of weeks ago, and an eigenlayer was fine, Athena was fine. Certainly two protocols that people were concerned about, embedded leverage of either capital or of trust. But good to see them get through the first sort of mini panic, I would say, for the market. But that's great, David. Thank you, David, Greg, and of course, big thank you to Jim for joining. That was super interesting to hear about Superstate. That's it from us this week. We'll see you next week. Take care.